Good evening. Good evening. Am I loud and clear?
Good evening. On my end, yes.
Okay, thank you. Let us start our class. Last time we looked at what we called the governance frameworks in corporate governance. We looked at corporate governance frameworks. And last week, we looked at directors. We looked at who are directors, types of directors, and the role of directors in our organizations. Now, let us look at something else, but we are still looking at frameworks, corporate governance frameworks. Today, let us look at what we call auditing, the audit structures and functions. This is what we shall start with today. The role of auditing in corporate governance. Corporate governance audit is an effective way to ensure that the company has complied with all the rules applicable and effective internal control systems, policies, procedures are implemented well to serve needs of all stakeholders. That's what we call auditing in corporate governance. This is one of the effective ways of ensuring that the company has complied with all the necessary laws applicable and effective. Now, laws applicable here, we are looking at external laws, laws from the government and government regulators, as well as what we are calling internal control systems, policies, procedures are implemented well to serve needs of all the stakeholders. That's what we call auditing in corporate governance. In this case, we are going to look at the two types of auditors. We have what we call internal auditors and external auditors. We have internal auditors and external auditors. Internal auditor, this is a trained professional tasked with providing independent and objective evaluation of company financial and operational business activities. That's what we call internal auditors. This is a professional we employ as a company, and their role is to provide independent and objective evaluation of company financial statements. Our company's internal auditor is there to monitor the activities and the work being done by the company's accountant and the finance department. In our company, we have the finance department. The work they do is monitored and regulated by the internal auditor. Then we have somebody else we are calling external auditor. An external auditor, this is an independent. The external auditor is independent of all clients, and they conduct audit and reviews and monitor the progress of the work of the internal auditor and the company's accountant, plus all other systems. They are in a good position to make an impartial evaluation of the financial statements and systems of internal controls of the company. Here, our concern is not only the financial statements of the company, we are also interested in the internal control systems. That is why in our companies, you find that we have procedures. To do A, B, C, D, we have this procedure and the Form A, Form B, Form C. The purpose of those forms and those procedures is to ensure that systems will operate according to the laid down control, procedures, and systems. And the external auditor will come to monitor if this is taking place. Apart from looking at the financial accounts, the profit and loss account, balance sheet, they will look at, are we following the laid down procedures when we are conducting our day-to-day business? According to the company policy, how should the customer deposit money? Are we taking cash? The company has a list of bank accounts where we should pay, where customers should deposit their money. Is that being followed? All that is an example of internal control systems. Through corporate governance, we shall establish several internal control systems to ensure that everything happening in the company is running smoothly. And to monitor this, the company will hire external auditors who will come and inspect and verify if things are working according to the plans. Remember, when we were starting this chapter, we said corporate governance is all about coming up with appropriate rules and regulations to control the conduct of the management. Remember, corporate governance is a tool that originates from the management, no, from the shareholders, the owners of the business. And the purpose of this tool is to monitor the activities of the management. Remember, we as the shareholders, we as the owners of the business, we come up with rules and regulations, policies, to ensure that the people we employ to run our business, the management, we want to ensure that they don't abuse their power. We want to ensure that the management will protect our wealth. We want to ensure that the management will safeguard our interest and increase what we call shareholders' value. Now, to monitor and confirm if this is taking place, auditing is more of a monitoring and evaluation tool. We use it to monitor and see if the management is running the business, running the company according to the approved rules and documents. Remember, documents are there to support the rules. And now we hire two people here, internal auditors and external auditors. And these are the guys who will look for any trouble and they tell us if somebody is not doing their job. The other type of auditors, we have currently discussed two types of auditors. The internal auditor, this is the person who is on a permanent payroll by the company, internal auditors. Then we have external auditors. We have said these are the guys we hire so that they can monitor and confirm if our own guys are doing things in the right manner. Then number three, we have another person we call the government auditors. Government auditors. And mainly these are experts, tax experts. These are auditors employed by the government to audit the activities of private companies as well as public companies to detect if people are avoiding paying tax. Is somebody not paying taxes as planned? Then we have government auditors. Then we have number 4, forensic auditors. These are specialized, they specialize in crimes, and they are used by the law enforcement organizations when financial documents are involved in crime. Economic crimes. When economic crimes takes place, now we engage the services of the people we call forensic auditors. So those are the 4 types of auditors. Anyone with a question? Before you go to the next part, are we together? By the way, how is the work based? How is the work based? Iko sawa, eh? And no question, eh? Now let us look at, in much detail, let us look at the role, some of the roles and the functions of internal auditors and external auditors. Let us look at what job each person does in a company. What are their main roles? We shall start with internal auditors. What are their main functions? Number 1, they ensure effective performance management and accountability. Internal auditors, they ensure that there is accountability on the part of now the accountant, the company's accountant. The auditor ensures that the accountant is doing things according to the book, accountability. Every money allocated is well spent with evidence of how the money is spent. They also identify and communicate risks and related controls to the company's board of directors, audit committee, and the management. This is another major role of these guys. It's their role to research and identify risks that might affect the company, financial risks, for this matter, financial risks, and communicate this within the prescribed time limit to the board of directors and the committee, so that appropriate action can be taken for the purposes of preventing the company from suffering financial loss. Number 3, they promote appropriate ethical behavior and conduct throughout the company. These are the people who are at the forefront of advocating for ethical conduct and behavior, not only from the accounting department, but by everybody in the company. These are the guys who are monitoring our activities. Are we filling the right forms? Are we filling the right forms? Are we following the right procedures? All over the country, ethical. This is the role of these guys. They also assess the corporate governance mechanisms and procedures. This is the other role of the auditor. The auditor will assess corporate governance mechanisms and procedures. To assess, this is to review, to check if what we have come up with as a company, the mechanisms and the procedures we have employed as a company, Are they serving the purpose we intended them to serve? This is the role of the internal auditor. Remember what we said. The shareholders, through the top executives, they will come up with a set of rules and regulations to be followed to avoid any loopholes where the company will lose money. Now, to test whether what we have come up with on paper, to check if it is working practically on the ground. Now, the auditor, the internal auditor will monitor each company policy and procedure and advise whether it needs to be reviewed, whether it needs to be adjusted, whether it is working or not. This is the role of the internal auditor. Remember, if our mechanisms, if our corporate governance mechanisms and procedures are not working, then the company will fail, and the company will not achieve the objectives of protecting and increasing the shareholders' wealth. So this is another very, very important role of the internal auditor. They also assist in preparation of corporate governance reports. When various reports from various committees are being prepared, the internal auditor will be involved. He will be part of the committees preparing these documents, and he will advise appropriately to ensure that what we are coming up with is appropriate. A minute, I take an emergency call. And lastly, the internal auditors will from time to time review the company's quality assurance programs and procedures. Review the company's quality assurance programs and procedures. This is another role they play. Remember, this is one of the most common objectives of all companies, to improve on the quality of a company's products. This is a very key core area that cannot be ignored. Remember, we shall only increase sales, we shall only get customer satisfaction if our quality is of the highest standards. So another very important role of this guy is to check if the measures we have put in place, the control mechanisms, the rules, the regulations, the procedures, this guy will check and see if things are actually working. Remember, we all come up with rules and procedures to increase quality. How do you measure if the quality of your company's products is increasing or reducing? Here we shall mainly look at the number of complaints from our customers, as well as the number of defective products. So the internal auditor will come up with tools to measure if the rules we have implemented as a company are the rules reducing the number of defective products, and this is the number of defective finished products. Is the number of customer complaints increasing or reducing? Now this is the other role of the internal auditor. If the number of complaints is increasing, that is an indicator that what we have put in place is not working. If we manufacture 1,000 finished products and the number of defective finished product is increasing from 1 month to the next, that is also a very bad negative indicator of a failure in the quality assurance programs and procedures. And that's another major role of the internal auditor. And that is how this guy maintains order in the organization. Then we have the other person, the external auditor. Let us look at some of the roles played by the external auditor. Number one, and this is very, very major. This is a major function of external auditors, to protect the interest of the shareholders. Protecting the interest of the shareholders. Remember, this is what we have been saying since the first lesson. The shareholders appoint the management to look after their assets. And now, the external auditor helps and assists the shareholders by going through the financial records. Are the profit and loss accounts cooked? Do the profit and loss account represent the true matter in terms of the financial position of the company? All of the accountants and the management are misusing company resources and cooking books. Now that is the role of the external auditor, to detect and identify fraud in the company. If the management are sleeping on the job, if they are breaking the rules, if they are breaking the company policies, now it is the role of the external auditor to detect this and communicate immediately to the shareholders. Remember, when we were looking at the definition, we said that the external auditor is independent, an independent person who is not an employee of the company, and in most cases, a stranger to our company employees. So this is a person who will be impartial, neutral, when it comes to detection of fraud, errors in the company. Number two, still related to the first point, external auditors report the state of a company's finance and attest to the validity of financial reports that may have been released. This is very important. The external auditor attest to the validity of financial reports. These are the people who will confirm, is the profit and loss account and the balance sheet, is it correct? Or we have some errors, is there fraud in those books of accounts? Or is everything okay? This is a very big major role of this guy, the external auditor. They will attest to the validity of financial reports that have been released by the company's accountant and approved by the company's internal auditor. So you can see that rigorous procedure: company accountant, company auditor, then external auditor. You can see that it's a very complex system, corporate governance system of ensuring that the shareholders' interests have been taken care of. Then we have number three. They ensure that the board receives accurate and reliable information. The external auditors are on the ground monitoring and ensuring that the board the top executives and the shareholders. They will get up-to-date information on the day-to-day operations of the organization. This is the person who communicates information accurately to the relevant parties to safeguard their interests. And lastly, although it is more of a repetition, the external auditor is responsible for investigating financial statements. This guy will investigate financial statements for errors and frauds. Investigate financial statements and determine whether they have errors or fraud. Is someone cooking the books? Is the profit genuine? Is the loss genuine? Now this is the role of the external auditor. Any question before you go to the next part? Anyone with a question? Before you go to the next part, anyone with a question? Okay, tuko pamoja, tuko sawa. Let us look at another very important aspect of auditing, what we call auditor's independence. How do we ensure that the auditor will give us results as intended? We call them the basic principles of auditor's independence. Auditor's independence is the cornerstone of the auditing profession and one of the fundamental aspects that makes audit functions value-adding services to society and the investing community. Yeah, the auditor's independence. You can see auditor's independence is so important. This is a fundamental aspect that protects the interest of the shareholders. As long as you have auditor's independence, then everything in a company will work according to plan. But if the auditor is compromised, if the auditor has no independence to perform their duties according to plan, then the shareholders will lose. And their assets will not be protected. Number one, let us look at the principles of auditor's independence. Number one, the auditor cannot be part of management or its team. That is the principle number one. Principle number one, the auditor cannot be part of management or its team. The auditor cannot be and should not be part of the management and its team. Now, you cannot be independent, you cannot be neutral if you are investigating the conduct of your fellow workmates. Then you shall have more of conflict of interest. Ukijua pale makosa imefanyika, badala ya kufichua rafiki yako, utaficha rafiki yako. Na hakuna kazi itafanyika. Company policies will not be implemented. Corruption will take place, fraud will take place, and no one will detect or raise a question. You can imagine the accountant auditing himself. Or you can imagine a company where we have the accounting department, and then on the side we have the auditing department, the same employees. These are people who socialize together, people who take lunch together, people who enjoy coffee together, people who watch Manu and Arsenal after work together. Can you monitor each other's activities? You cannot. So the auditor should not be part of the company. He should not be an employee of the company. And once we do that, we ensure that the people we employ to check on the performance of the others will give us a fair, true representation and picture of what is happening in the company without discrimination or favoritism. Number 2, the second principle, auditors cannot audit their own work. Auditors cannot audit their own work. This is another second principle that is very important. You cannot shoot yourself. You cannot victimize yourself. Tunasemanga wezi jitunga kisu. Kama unajua umekosea, you cannot honestly disclose that. You like to hide the mistakes. So as part of ensuring that the auditors are people who will give us results, let somebody else go through your work and determine whether it is okay or not. Let somebody independently go through your job, your work, and detect mistakes independently. But now once we give you the responsibility of judging yourself, vetting yourself, it will not work. You will hide the mistakes. And the shareholders will lose their money. If you steal money, you cannot honestly put it in a report that money is missing. You will come up with a way of hiding the money. But as long as you don't scrutinize your own work, let somebody else judge whether you have done a good job or not, then we shall achieve what we call auditors' independence. Auditors' independence shall be achieved. Then we have number 3. The appointment of auditors. This is another very big principle, the appointment of auditors. As a company, let us come up with appropriate rules governing the appointment of auditors. Remember, if the auditors' selection and appointment process is compromised, if we don't have strict rules to govern this, then we are going to, in the very beginning, we are going to bring on board somebody who is not going to do their job independently. We should also ensure that even the shareholders should not compromise who is given that job of auditing. If a shareholder is able to compromise this, then it means the auditor who is coming on board will be compromised. And they will not communicate appropriately and honestly the true nature of activities being performed in the organization. So let us make sure that our rules and procedures are properly followed, and they are going to give us the appropriate guy who will monitor our activities. And the last principle is what we call the manner in which services are performed. Manner in which services are performed. In most cases, when an audit is taking place, it is common knowledge, common practice that the big guys should go home, what to end the leave. Because sometimes when the auditor is doing his work, people can interfere with their work, such that they end up limiting evidence or compromising the audit exercise. The auditor should not be friends with the people he is investigating. He should be professional. You should not be casual. You should not establish a casual relationship with the people you are investigating. That will raise doubts on the credibility of the entire exercise. So let us come up with rules and procedures to guide the auditor when he is conducting this exercise. What is he allowed to do, and what is he forbidden from doing? What are the do's and the don'ts, the boundaries? If you find the external auditor and the internal auditor and the accountant taking lunch, then that will raise suspicion. What will be the outcome? So those are the principles of independent auditor, the guidelines that ensures that the exercise we are performing will be above board, and it is going to give us credible results that will help the company and protect shareholders' interests. Any question? Any question? As we go to the next part, any question? Tuko sawa, eh? We are together.
Yes, sir.
Okay, your cat, by the way, your cat is also already there. Your cat is also already. Kati yenu imepikwa, imeiva, imewekwa roiko, imewekwa chumvi, imebaki kupakuliwa, eh? You shall, I gave you 3 questions, eh? Cut, you shall have 20 questions. Cut in 20 questions, eh? The first 10 questions, yes, 20. 20 questions. The first 10, ni multiple choice, eh? The first 10 questions, multiple choice questions. Then the other 10 questions, ni short answer questions. Everything is out of 30. And you shall have 3 hours. I've given you 3 hours to do the cut. From 6 to 9. Not 2 hours, 3 hours. Yeah. It will cover everything, including what we have done. Last week. What we are doing today will not come in the cut. What we are doing today will not be tested in the cut. It's what we did the other week. The role of directors. All the way to chapter 1. So wale wanatumia simu, make sure that today you have a laptop or a desktop. Kama hauna, uongee vizuri na neighbor. If you don't have a question, let us proceed. Iverson. Yeah, you shall type. Yes, Purity, you shall type on the system. No attachments. You type on the system. Evans, ongea vizuri na neighbor. Mwezi kosa neighbor ako na laptop. Or if your phone is also good enough, you can also use your phone. If your phone is good enough, you can also manage with it. As long as you are comfortable typing and accessing the questions. Si lazima utumie laptop, but as long as your phone is okay, you can handle that. Now let us look at something else we call auditor's competence. Auditor's competency. This is the ability of the auditor to provide reasonable assurance that financial statements are free from material misstatements, whether caused by errors or fraud. That's what we call auditor's competency. Now we are looking at the ability of the auditor. The person you have hired, the auditor you have hired, are they capable of delivering what you want? Will they give you results? Will they deliver the results you expected in terms of providing, without a doubt, reasonable assurance that the financial statements are 100% correct without errors or fraud? This is the guy who will look for now human error. Do we have human error on those statements? Or now do we have now intentional and deliberate fraud? We have intentional and deliberate fraud. To ensure this, we look at 4 things. We look at 4 things. Number 1, professional competency. Number 1, we check professional competency. This is now basically looking at the academic papers of the auditor we are hiring. Who are we hiring? Do they have the minimum educational qualifications expected of this job? We can see a minimum of a degree in accounting, CPA, KA. Hiyo ni masomo. Membership to ISPAC. Then most important, element 2, we look at technical competency. Technical competency. We can now take them through a vigorous interview process to verify if they are going to deliver, to confirm if they are capable of giving us results as intended. That's what we call technical competence. We don't want someone who has very good papers, but now they cannot deliver. You can have very good papers, but when it comes to delivering, you are not able to deliver. Okay. Number 3, we also check at process competency. Process competency. This is where we look at the auditor's ability to follow rules, regulations, and procedures. Remember, if you are a person who avoids procedures and processes, if you are a person who likes shortcuts, if you are a person who ignores documentation, that is a red flag for being incompetent. You know and you understand the company's procedures and documentations, but you choose to ignore them. That is a red flag for fraud. People who avoid paperwork and the people who avoid following the law, people who like shortcuts, always end up being the people who are committing fraud. So we should check on our auditor and we find out if they have this weakness or they are okay. If they are okay, if they observe rules, if they follow procedures, then we say they are of high competency. We presume that the competency is high. And then lastly is what we call reporting competencies. Reporting competencies. As auditors, every company has their own policies on how the auditors should communicate to the shareholders and the committees. So now as an auditor, you will be monitored. Are you communicating frequently and in the right channels as expected? The company will come up with procedures to guide how auditors should communicate, how often, through which mechanisms, and to who. So now if you are an auditor, even if you pass the other 3 tests, but then when it comes to communication, you are not communicating, then that will make you incompetent. We shall presume that you are incompetent and you cannot deliver. Remember, your purpose is to inform the company and the directors of anything happening in the company in terms of financial and internal controls. So if you keep quiet, you are not doing your job, and somebody else will replace you. So those are the 4 areas of competence: professional competence, technical competence, process competence, and reporting competence. And those are the systems we use when we are appointing auditors. Let us look at something else. Remember, if you have an issue, you raise it as we proceed. We are going to look at some of the shortcomings of external auditors. We looked at who are external auditors and the role they play in our companies and how they assist us as an organization. But sometimes things don't work the way we plan. Sometimes the external auditors can also fail us. So we are going to look at shortcomings or some disadvantages of engaging external auditors. Remember, we said we rely on these guys so that they can communicate to us appropriate information necessary to safeguard our assets and the interest as shareholders. But sometimes things don't work out the way we planned. For example, number one, there's a limitation of evidence gathering procedure. Remember, this guy is new to the organization. So even if he has the good intention of investigating and identifying the fraud, sometimes when it comes to evidence gathering, this may present a challenge that will interfere with the work of the auditor. Evidence gathering procedure, this might be a problem. That might make it hard for this guy to perform their duties. Evidence gathering. Another problem is possibility of collusion. You might bring along an external auditor who is expected to be tough on the internal auditor and the accountant and the management. But these guys might end up working together. What we call collusion, possibility of collusion. The external auditor might enter into a handshake arrangement na internal auditor, wakuwe marafiki, waanza kufanya kazi pamoja. So this guy might end up covering up for the people who are misappropriating funds. The external auditor might now cover up for the management. Management wakijua kuna pahali wamekosea, wanafanya handshake na external auditor. Mambo yote inafichwa. This is another shortcoming of using external auditors. We also call this management override. Management override. The management, remember the shareholders, the owners of the companies are hiring the external auditor to investigate the conduct of the management. Remember, if the external auditor finds anything wrong taking place, he will report the management to the owners of the company, to the shareholders. So now management wanaweza leta corruption in, management override. Management taking over the audit process. We will not get to know the true matter, and fraud and corruption will take place. Another problem with the use of auditors, I know you are all familiar with accounting. You are now in DCM3. Somewhere in the past, DCM1 or DCM2, you have done accounting, FA1, FM. You know, when we are preparing those books of account, sometimes we do what we call use of judgments in preparation of financial statements. The use of judgments and the use of accounting estimates. The use of accounting estimates and judgments. Sometimes this is part of accounting. It is not a fraud. It is part of the accounting process. Use of estimates and judgments. So this may make it hard for the external auditor to detect fraud, because we might categorize the external auditor might raise a red flag on a particular area, and the company's accountant might support that as part of approved financial estimates and judgments. They might even quote ISPAC rules and regulations. Remember, ISPAC regulates the conduct and the work of auditors in the country, and they give rules on what is appropriate and what is not appropriate. So sometimes the accountant might take advantage of this professionally approved accounting estimates and judgments now to commit fraud. And this will make the work of the external auditor very difficult, because they can do nothing. After all, this is above board and it is approved even by ISPAC and other professional bodies. So those are the challenges that sometimes make it hard for the external auditor to perform their roles as expected. And they end up not giving us and performing the duties we expected them to perform. And in the end, the shareholders will lose their investment. Any question? We have come to the end of that chapter. That is the end of that chapter. Last week, we looked at the role of the directors. Remember, we are looking at corporate governance framework structures. Last week, we looked at the directors. Today, we have looked at the role of the auditors. The role of the auditors. Now, after your cuts, next week, we shall not meet. We will be doing your cuts. After the cuts, now we shall look at the role of the management. All this is part of chapter 4, but it is divided into several subsections. Today we have concluded on the role of the auditors in promoting corporate governance in organizations. So next, after cuts, we shall look at the management. Any question?